Hook. In just 7 days, $60 billion disappeared. One of the largest cryptocurrency exchanges in the world collapsed, almost overnight. Customers couldn't withdraw their money. Investors were stunned. And the man who was once called the next Warren Buffett was suddenly facing prison. This is the story of how FTX imploded in 7 days. Rise of FTX. FTX was founded in 2019 by Sam Bankman-Fried, known online as SBF. He wasn't flashy. He wore cargo shorts, drove a Toyota, slept in the office. But behind that casual image was one of the fastest-growing crypto empires in history. By 2021, FTX was valued at $32 billion. Major venture capital firms invested hundreds of millions. Celebrities endorsed the platform. Stadium naming rights were purchased. FTX wasn't just another exchange. It was marketed as the safe, responsible face of crypto. Hidden structure. FTX wasn't operating alone. It had a sister company, Alameda Research. Alameda was borrowing money. A lot of money. Much of its balance sheet was made up of FTT, a token created by FTX itself. So if FTT's price dropped, Alameda would collapse. And if Alameda collapsed, FTX would be exposed. It was a fragile system built on confidence. News leak. On November 2nd, 2022, a report revealed something shocking. Alameda's financial health depended heavily on FTT tokens. That meant much of its value wasn't real cash. The market asked, what happens if everyone tries to withdraw at once? Bank run. Then came the tweet. Binance announced it would sell its holdings of FTT. Panic erupted. Investors rushed to withdraw funds. In 72 hours, over $6 billion was requested in withdrawals. Collapse. On November 11, 2022, FTX filed for bankruptcy. Over 130 affiliated companies collapsed with it. Billions in customer funds were frozen. What was once valued at $32 billion was now worth virtually nothing. Aftermath. Sam Bankman-Fried was arrested weeks later. Prosecutors alleged fraud, conspiracy, and misuse of customer funds. The crypto market plunged. Trust in centralized exchanges was shattered. For many investors, this was crypto's Lehman Brothers moment. Lesson. FTX didn't collapse because crypto is volatile. It collapsed because of leverage, lack of transparency, and dangerous conflicts of interest. The lesson is simple. Trust is everything in finance. Once it's gone, it disappears faster than anyone expects. $60 billion, 7 days, and a warning the industry will never forget.